Today we're going to be walking through a current client case study, and I'm going to be incorporating a lot of the key concepts that I shared in my previous video, which I'll post below, on how to retire with $2 million without running out of money. And you'll see when I run through the case study and we run scenarios, the mindset I have as a financial planner to adjust and help clients, because part of my job is to look for blind spots, look for yellow flags or red flags, and try to remove barriers so that they can retire on their terms and just be happy. So let's jump into the case study. So currently right now, we have two clients. We have Jesse and Sandra, last names hidden for privacy reasons, but they're both 62 years old. And to give you a sense of their goals that they have, they would like to retire at age 65, and they have a retirement monthly expense goal of $8,000. So they want to be able to live a nice lifestyle retirement with $8,000. They also want to plan for additional healthcare costs. So we took an annual average of the estimated additional healthcare retirement costs they're going to have. So it's roughly $6,397. And then the big one here is they're really into travel, is they want to take family vacations. They want to be able to take 2 to 4 trips per year. And they're thinking it's going to be roughly about $25,000 per year. Now, when we look at their income sources in retirement, well, currently right now, they have 3 more years before they want to retire. So Jesse's salary is $150,000. Sandra's salary is $100,000. And currently they're planning just to take Social Security at their full retirement age, which is age 67. And we'll have those numbers here on the next slide. And when we look at their overall situation here, their net worth is roughly around $3.4 million. So the way that breaks out is, starting from left to right, is we have Jesse's investment account, which is his workplace 401k. They're jointly held accounts. They have a bank account, high yield savings account with about $150,000 in there. They have another taxable investment account that has about $450,000 in there. And then they have their primary residence, which is $1.4 million, and they have 0 debt on it. So it's 100% paid off. And then lastly, they have Sandra's IRA account that has roughly $400,000 in there. So that's a general sense of where they're at financially. And so they want to know, well, can we do this? Can we retire at 65? Well, the first thing we're going to do, we're going to run through a couple of analysis here. So I run an analysis called a Monte Carlo. In its simplest form, we run 1,000 different simulations: good markets, bad markets, high taxes, low taxes, maybe you live longer, et cetera. There's all these different things that we'll do. We'll take 1,000 Jesse and Sandra's, and depending on the average outcome, that's going to be the probability of success, AKA the percentage or probability that they will never run out of money. So in this case, in their current situation, it's at 66%. So let's take a look why. Why is this at 66%? Well, again, as I mentioned in my previous video, we have to know exactly what is coming in versus what is going out. So when we go to their retirement, we're going to see that at age 65, they have no more income coming in. So we want to get an understanding of what are their income flows. So there's no more income coming in at 65. Then we're going to look at their guaranteed income flows. So the only guaranteed income flows they're going to have is Social Security. So if they plan on taking Social Security at age 67, that's roughly going to be a little over $90,000 per year. And then it's going to go up with inflation, all the way till end of plan. Then we also want to know the rest of their numbers. We want to know what their expenses are. So if their living expenses in retirement at inflation adjusted is going to be, roughly a little over $103,000, we quickly see that because of inflation and because of their current portfolio, we're seeing this compound dramatically. Okay. More on that here in a second. And then also we have to account for the goals that they have. So then we have their annual vacation goal starting at age 65. So again, this is going to add to their cash flows. And then we have taxes, of course. So we're doing a tax analysis as well and projection. So we'll look at their tax bill and we'll see that it's pretty low from age 65 to age 71, if you will. There's a window there. And you might have heard of a thing called Roth conversions when we're trying to take advantage of low tax years to move money from pre-tax to tax-free accounts. So right off the bat, as an advisor and as CFP, I'm thinking, oh, that could be a good window to maybe do some tax planning. But then we're looking at, their tax bill continue to go up during, over time. And so when we look at their net flows, so when we look at retirement age at age 65, we're automatically seeing, the first year they're going to be negative 182, then 185, then 103, then 95, 96, 98, etc. Every single year we have a negative net flow. So that essentially is the reasoning why they have such a low probability of success, is because they're going negative every single month. Now, that's not saying they couldn't do this, because if you look at their net worth over time, if they do nothing different, so if they just stick to their plan and don't change investments, don't do tax planning or any of that, if they don't do anything different, they're still going to have a nice net worth at end of plan, $5.4 million. Their invested assets, as they're invested today, they're still going to have an ending balance of $2.2 million. So if they were caught in a bind or something like that, or they found themselves running out of money, they could all obviously sell their primary home if they had to, right? And downsize. So that's their escape route, right? They have this asset here that's growing. So let's say they get to age, 80 years old, and they ran out of money for some reason, then they have a $2.3 million property that they can borrow from, or they can sell or something. So there's always a strategy there. But once we look at this though, I'm the type of person where, it's all about optimization. How can we optimize their current plan? I mean, how can we get this from 66 to 76 or 86? And it's not about these numbers too, because like I said, they could do what they're doing now and retire just fine, probably have a beautiful retirement. But if we can optimize it, if we don't have to pay Uncle Sam a tip, if we don't have to, if we can use our assets to work harder for us, and as the rich get richer, wealthier get wealthier, we could do the same thing by putting our money to work for us in other ways. And also, what are some other red flags that they have? So let me just walk you through some adjustments I think that we can do right off the bat. So the first thing that we're gonna do, obviously, is we're gonna look at their estate plan. So they have nothing. They have no will. They have no power of attorneys. They have no healthcare proxies. They have no living trust. So these are very, very important to have. Oftentimes with clients, this is the first thing we tackle, because if you don't have an estate plan, in my opinion, you have a broken plan. You don't have a full, complete plan. So those are some things we're going to tackle right off the bat. We don't want your assets going to probate. I've heard horror stories about people spending tons of money on lawyers just to get their assets out of probate, or maybe there's family bickering and confrontation. You don't want to leave your estate to chance. You want your stuff to pass on to the people you want to have your assets. You want decisions to be made right off the bat. So that's the first thing we're gonna do. The next red flag that I saw was if you notice, their investment portfolio and their net cash flows, they were negative every single month. So that tells me right off the bat too, without even looking at other portfolios, if we look at their current situation here, they're roughly 59% in bonds and cash, and only 41% in U.S. equities and other asset classes like real estate or what have you. So that's a pretty conservative allocation. And as I mentioned in previous video, we have something called inflation that we need to worry about. We have taxes we have to worry about. We have longevity we have to worry about. I mean, just because they retire at 65, they have a really high probability that they're going to live to 90 plus. So what happens if they live to 95? What happens if they live to 100? So we have to plan for these years, right? So you have to plan for 30 plus years. So this investment, in my opinion, this portfolio is a little too conservative. I'd probably opt them to go for at least 50-50, or maybe even a 60-40 type portfolio, maybe even 70-30, who knows? But at least a 60-40. Because when we look at the analysis here and we start running numbers, by just making a very quick allocation change. So if we put them in a moderate portfolio at, for example, 60-40, let's take a look. What does this do to our plan? Well, now it takes us to 75% probability of success just by doing this. Now we have roughly a little over 1.3, almost $1.4 million of additional assets by just having a properly structured portfolio that's going to be able to close the gap, if you will, on those negative years. The next thing I will do, because their expenses won't be very high, is maybe let's talk about Social Security. Maybe we can have a more optimal strategy with Social Security. Maybe we don't need to do it at age 62 or what have you. Maybe we can do it at age 70. So if we do this at age 70, now we're going to have 388,000 more in benefits. Now, I'm not saying they should do that. I'm just saying that's an option. They don't have to wait until 67. They can wait till age 70 essentially to get more benefit. Now, going back to the analysis here, another thing that we can take a look at with this client is we can look at potentially retiring sooner. So maybe they don't have to retire at age 65. Maybe they want to retire sooner. So in this case, maybe they can. Maybe they can retire at 64. And if they retire at 64, we can see, okay, well, what does this do to our strategy now? So we're at 75. Now it takes us to 60. Like, oh my gosh. Well, all that means is maybe you just have to adjust your expenses. Maybe you just cut back $1,000 every single month just to make sure that you can achieve your financial goal. And now we go from 60 to 78. So you could probably spend more than that. You could probably spend 7,500. So not that much different, but now it's just opening this client's eyes, telling them, hey, you could actually retire sooner if you'd like. You don't have to wait till age 65. You could probably do it much sooner. So it's being able to pull these levers and make these trade-offs here and there so that you can actually achieve your financial goal. But one of the things that I wanted to share, if we go back to the original scenario here, if we look at a couple of adjustments here, and we go back to the original, let's say, like I said, they want to spend $8,000 a month. What if we looked at their portfolio and we found that A, it's not aligned with their values, and B, they're actually way more aggressive than they actually thought. So what if we even put them in a 70-30 type portfolio, a growth portfolio, because they'll have Social Security that's closing the gap. They'll have, they already have a good handle on how to budget and spend. And when we look at that comparison, now we're $2.7 million more in ending assets with this plan because we've adjusted the portfolio. We've put them in a position where they can capture more gains and they can take advantage of the markets versus their current portfolio that's very much in fixed income. And it's not by this client specifically, they're not in a lot of fixed income bonds and cash because they're conservative. They actually just don't pay attention to it. And that's why they reached out to my firm. They want to delegate it. They don't want to pay attention to the markets every single day. They, like I said, very good at retirement saving and very frugal and good with their money. But when it comes to the actual retirement planning and tax planning and investments, they just don't want anything to do with it. So this is just, again, another example. So if we go back to the actual cash flow tab and we look at the numbers, when we're looking at the summary in the proposed plan, we're going to see these net cash flows dramatically improve here over time. So we're going to see now at age 77, we're actually in the positive. We're actually seeing net positive cash flow year after year after year. So what does that mean? What that means is actually you could probably spend more money in retirement. You don't have to stick to 8,000. Maybe you want to go on 5 trips a year, not 4. Maybe you have another goal you wanted to fund. Like all of these different things you'll be able to do because you just, like I said, you just made a couple of different portfolio changes. And now, I believe before it was a little over $5 million that they have at end of plan. Now they're at 8.2 at end of plan. So goes without saying that if you're invested properly, you have the right tax plan, you have the right cash flow strategy, you have the right retirement mindset, you could probably spend more in retirement. You could probably retire sooner. You could probably retire with less taxes. You could probably get more Social Security benefits. There's all these different pros that you can have. So hopefully this was helpful. This is, again, an example of how I would look at a client situation, run a projection, let them know if it's possible or not possible to achieve their goals, make adjustments if need be, figure out cash flow, figure out tax, Social Security, estate plan. Luckily, they don't have a lot of debt, so insurance and debt planning wasn't a huge need. But again, giving you a sense of looking at this from a comprehensive perspective and aligning their plan with their values. So hopefully that was helpful. If you have any questions, go ahead and drop them in the comments here. Don't forget to subscribe so you get all the content. I'm releasing at least one new video every single week. Thanks so much for watching. I'll talk to you soon. Once again, it's Eric Rodriguez here. If you're looking to get help securing your financial future and you're serious about implementing a wealth plan for your specific situation, feel free to check out my website, wealthbllc.com, to learn more about how I work with clients, how I help them align their resources with their values, and put together a comprehensive plan to help them retire on their terms.